Evening and welcome to this week's edition of Wealth Quest. I'm Samantha and this is our monthly series called Wealth Quest Let's Get Graphic. We take a look at some of the most thought-provoking graphs we've seen during the month. Now we'll be discussing these and looking at the investment implications that these hold. Often social, economical and political issues transpire to drive returns in the markets. Now this is sentiment ebbs and flows as it tries to find fair value for the markets. So tonight we'll be looking at a collection of graphs that, as we say, we found thought-provoking during the last month. Maybe you have a graph you'd like to share with us. Please do email us that graph to wealthquest@abn360.com. As per usual, I'm joined by my two strategists at the desk, Cobie, Legrange, strategist at ClucasGray Investment Managers, and of course Roland, Rousseau, equity strategist from ABSA Capital. Gentlemen, let's get graphic. Cobie, you can take the floor with your graph.
Yep. Well, I think the big thing in the last quarter was what happens when US yields actually start moving up. Now, there's lots of opinions about this, and lots of people will say to you, own this, but don't own that. I think this will work, and I don't maybe think that'll work. But quite frankly, it's pretty low. There's lots of opinion, but pretty low as far as actual data is concerned. And I actually found a paper that you might find interesting to have a look at. This is written by James O'Shaughnessy, and it asks the question, do you need an income? And it looks at two graphs here, or two tables. The one is a bond bull market, and obviously the bull market that you're having a look at is obviously the table that you see on this side of the screen over here. And that obviously is as yields moved from 1981 from 13% to 2.6%. And I'm talking about US yields in this situation. Look where stocks perform. There you can see the stock performance at 10.6. Look at long-term government bond yields and long-term corporate bond yields. Look how well these actually do relative to stocks. But what happens when that reverses? What happens when bond yields now, as what happened in 1951 to 1981, actually moves the other way? Here, bond yields moved from 2.6% to 13%. And look what the top performing asset class is. Equities, right at the top end of the screen. They're up at 9.8%. And here you can see literally all your rest of your bond kind of market hanging at the bottom end of those returns. Look at your long-term government bond yield returns, only about 1.8% relative to the 11.3% that we've seen previously.
Mm-hmm. Any thoughts on that, Roland?
Yeah, I mean, that's clearly the beginning of a new bond bear market that this graph is hinting at. We must understand that this is a long period, and I dread to think that the bond investors have to pack up and go away for 10 years before that turns around again. So there'll be cycles within that, but this is clearly a reflection of inflation trends, right? So when inflation picks up, we start to see that equities are the preferred asset class by a long shot. So everyone is expecting inflation, so that is why we're seeing equity markets at record levels.
Yeah, there we go. And you're going to be talking to us about where you see equity markets going.
Samantha, you've got some interesting graphs.
It's my chance to speak now.
And it's your
Finally,
chance
I've
to
been waiting for
actually
this
show some graphs. So please take us through what you believe, if you've seen in the last quarter's importance.
Yep. So basically, recently we saw newspaper headlines with a Saudi Arabian prince warning, as you can see that's his face, warning about the danger of the US shale gas revolution that we're seeing, the threat that really poses to the Saudi Arabian kingdom. At this point in time, we know that Saudi Arabian revenue, 92% of that comes from oil. So of course, that's extremely important if you look at that in the context of Saudi Arabia. It's the world's largest petroleum products producer. And of course, if you look at that on the screen, you'll see that relative to the United States and Russia is making it, as you see, coming out on top, exporting 8.6 million barrels per day in 2012. So it also contains around 16% of the global total of oil reserves at around 268 billion barrels per day. So very important what happens to the US economy when it comes to the oil and gas revolution that's taking place there. If you look at where Saudi Arabian oil goes, you'll see that 15% of that at this point in time is going to the United States. That picture has changed because that's down by a third right now because, previously the US used to get a third more from the Persian Gulf region as a whole. So that, of course, has been a changing dynamic already, but more and more the Saudi Arabian kingdom is concerned about what the picture is going to look like going forward. You see that the Persian Gulf accounting for around 22% of the US oil imports. Now, the picture is changing, and of course what has come to mind is the IEA documents in 2012 talking about the oil outlook for the United States, saying that the United States economy is projected to become energy independent by 2020. By 2020, they're expecting the US to overtake Saudi Arabia as the world's largest oil producer, and basically by 2030, they see the oil industry changing because the US is expected to become, in fact, a net exporter of oil. So, of course, this is a threat to the Saudi Arabian economy. This is a threat to geopolitics, politics globally, because we know that the United States has had a massive presence in the Persian Gulf, protecting those shipping lanes there. So, let's just take you through what's taking place in the United States when it comes to changing dynamics. So when it comes to the gas picture, first and foremost, we know that over the last couple of years, hydraulic fracturing and horizontal drilling has enabled access to large volumes of shale gas that were previously uneconomical to produce. And as you can see going forward, from around 2015, 2010 is really when it starts. You see that shale gas is the majority driver of the growth in gas production in the United States. We see that the United States, in fact, of course, will be able to produce all of the gas it consumes going forward, and it will, in fact, become a net exporter of gas. When you look at crude production figures, we know that stats, as we were showing previously up on the screen there, we've seen US crude production up by 14% between 2002 and 2012. So we have seen a sharp recovery since 2008. And as we were saying, the IEA projecting that by 2030, the US will become a net oil exporter. So this, of course, is changing the global dynamics when it comes to energy needs and when it comes to where oil is going to be moving. The last slide I have for you is very interesting there because it shows where Middle East oil is going to be moving. You can see the shift between the West and the East. You can see earlier on most of that Middle Eastern oil, of course, 2000 and 2011 was majority going to Japan, Korea, Europe, and USA. And you see by 2035, the projection there is that USA will be importing a minimal amount from the Middle East, and you've got China and India, which will be the majority importers of Middle East. And this, of course, has all implications for the US security presence in the Gulf region. So that, of course, is my blurb there. Just wondering if you have any comments on that.
Well, I suppose it's not just how the US security situation changes, but it's also how big petroleum companies actually changes their energy portfolios. Because previously, it used to be only about trying to find oil and trying to find it at the most cost-efficient points and being able to, transform that into the actual petroleum that you can buy at the pump. That no longer is the case. It now becomes about a very diverse energy portfolio and trying to make sure that you actually optimize this in various countries. And what is an answer for one country is potentially not an answer for a different country, which makes the whole energy and analytical area actually quite a very interesting place to watch at the moment.
Yeah.
What mystifies me is why, given all this information and research that shows us that the supply of oil or gas is going to increase, which should effectively create a lot more supply, which should lower the oil price. But we're not seeing that. I personally don't know why, but of all the commodities, oil is the only one that hasn't come down. Now, at some point, this
it's
sounds
because you
like
drive such a large car and you're responsible for that to a degree, Roland.
I don't know if my car is that large to
energy
boost,
guzzling
global oil prices. Look, there is obviously talk about political instability in the Middle East, and that's why the oil price is sticky in terms of staying where it is. But it cannot sustain itself at $109 with this kind of production coming on stream, not that far into the future.
But the dynamic is what we're seeing in that final graph there, where you saw the shift going from the US, from the Western world, ultimately to the Eastern world. So it's almost the shift in the fact that the US is not needing the Middle East as much. The US, in fact, also turning to the likes of Canada more and more, turning to South America more and more, Brazil, Mexico for its oil. Russia even is coming on screen as a greater producer of oil for the United States, and the shift is going to where we're seeing growth, and that, of course, reflected in China and India.
You see, the large part as well, and I think an answer to this question is also the change in technology in order to make sure that you can make use of shale gas. I mean, the shale gas find is one thing. Bringing it to the surface has now been pretty much perfected. I think they've kind of got that going. But now to transform it and make sure that you actually have all the mechanisms in place in order to make sure that you can use this as an energy source, continues to be in development. And you're not seeing much of that happening. You're seeing it happening, but it's certainly the technology is still kind of still behind what as far as shale gas extrusions are concerned.
Let's hope that when they finished with the Karoo, it's not going to look like the old mining operations in terms of mine dumps lying around once they fracked the Karoo, because that's clearly where the new industry sits in South Africa.
Yeah, and of course, changing dynamics for South Africa. Let's get into your graph.
I've just got one last comment to make on a graph that I find very pertinent at the moment. If you look at the bottom part of the graph, you will see the S&P 500, which clearly fell in a heap in 2008 and subsequently has more than doubled. So we've had some phenomenal returns from the US market in terms of equities. The top graph shows you the VIX index, in other words, the volatility levels embedded in the S&P 500, and you can see that volatility spikes during periods of crisis. Currently, volatility is at the same levels it was prior to the subprime crisis, so back in 2007. So we have record high returns with record low levels of volatility. This probably is telling us that at least before the end of this year, you can't have volatility doing nothing and equity markets keep going up. So we're quite concerned about a short-term sell-off. So if anybody wants to buy equities, now is maybe not the right time, but wait to see for a bit of a correction before getting into that. But it's definitely a short-term kind of effect. But clearly, these signals are concerning.
I mean, we've had the US earnings season, European earnings season to take a look at fundamental earnings. I mean, what are the thoughts right now in terms of to what degree earnings are supporting price levels?
Yeah, it's a bit mixed, as in some sectors in the market are surprising in terms of analyst forecasts, and some aren't really delivering as much. But on a broad-based approach, there's definitely strong signals coming out of the US, and clearly any threat by Mr. Bernanke to stop the taper sooner than later will create another sell-off dramatically, and that's sort of what these graphs are implying at the moment.
From an earnings perspective, I mean, S&P 500 has literally just crested its earnings numbers that it generated back in 2008. So half a decade of really, really hard work by central banks and by corporates in order just to try and lift back the earnings to where we were before. So it's literally just crested beyond that level, and that's why you're seeing this momentum now kind of going. But it's uncharted territory now. Where to from here? And kind of, I want to maybe add to that. If the alternative is South Africa, then I would still say South Africa and other emerging markets is more expensive than what your G7 countries are.